Today is December the 19th, 2022. Welcome to the Brent Bruce Daily. It is currently 3:02 p.m. Central Time. The markets are fairly calm today ahead of the big report coming out on the 23rd, which is our newest release of the personal consumption expenditure, which again, as you know, is the favorite measure of inflation that the Federal Reserve likes to refer to. So it's very important that this comes out showing inflation subsiding and we continue down the path that we have been projecting now for months and months, allowing the overall interest rates to come down. Now, because things are a little bit slower today, I'm going to take a minute and try to explain a little bit of detail about why I want some charts to go up and some charts to go down. We'll take a look at the charts. We'll take a look at the interest rates, but I'm still going to try to get through this pretty quickly. So let's jump right in. Okay. So here we are, our overall mortgage-backed security that we're looking at, and this is the 5.5% coupon. Okay, so keep that in mind, is down 41 basis points. The 10-year Treasury yield is up 11 basis points, and I'm going to explain the bond price versus the yield. That's the difference that I'm going to explain a little bit of today. So this chart that we're looking at here, we're starting with is the 10-year Treasury. Now, again, we don't like to see this going up, but we do have a little bit of comfort knowing that just a little bit above this, we have a dual ceiling of resistance at both the Fibonacci level and the 25-day moving average. So there's going to have to be something pretty aggressive or a pretty poor report or showing inflation is higher than expected for us to break through both of these ceilings, which is reassuring to us in the mortgage-backed security world. So let's take a look at the MBS chart. And it's kind of the same story. So basically, you have not a really good day, down 41 basis points, but we're still in between this ceiling of resistance at this Fibonacci level, which is 101.671. And now look at this. What is this? This is a triple floor of support at the 25-day moving average, which is this line here, the 100-day moving average, which is this line here, and the Fibonacci level, which is this line here. So we would have to have, again, a pretty ugly report come out on the PCE to break through all three of these to see the mortgage-backed security go back down to some unhealthy levels like where we were in the past, which is good news. We've built some pretty good floors and ceilings. All right, so what are we talking about when it comes to wanting the mortgage-backed security to go up, but yet wanting the 10-year Treasury to go down? And that is because we're measuring two different features. We're measuring two different things, okay? So the 10-year Treasury, this is the yield. This is the rate of interest that this bond is paying, okay? So understand, this is the actual, think of this as the actual rate of interest that is willing to be paid. So right now, let's just say that today, at this moment, if you bought a 10-year Treasury bill, it's going to pay 3.59%. All right. So what we want, again, we know that home loan interest rates compete with the 10-year Treasury. So if they're competing with the 10-year Treasury, let's say that today the interest rate's 5.5%, for instance. If the 10-year Treasury drops to 3%, then it allows the mortgage interest rate to theoretically drop about 0.5% as well, because they compete with each other. So the point is, this is the yield, the rate of interest that the Treasury bond is going to pay. This is the price that someone would pay to buy a mortgage-backed security with a 5.5% interest rate attached. So that is what's called a coupon or a coupon, whichever way you pronounce that. So if they're not willing to pay as much for a 5.5% interest rate, like, I don't want to pay that much. What they're telling you is that they're losing their appetite for a 5.5% mortgage-backed security. What do you do in order to entice a greater appetite? You raise the interest rate. So if you raise the interest rate, then you will have more appetite, and all of a sudden this will not go down, this will go up. Now, this is a very general explanation of what we're talking about here today. And some people might actually say, well, that's not really how it works. Again, we would have to really get into some great detail to explain exactly what I'm talking about. But that's the way that you want to look at this. This is the interest rate for a 10-year treasury that we want to go down. This is the price that an investor is willing to pay for a 5.5% mortgage-backed security coupon. And we want that price to go up. All right. So understand that if you can. Let me know what you think about that. And if you have any questions, if you want me to explain this in greater detail at another time. So let's take a look over here and pull up our loan sifter to see where we are on interest rates as of this moment. Log in. And again, this is going to be the very well qualified 30-year fixed conventional home loan here today, Monday the 19th. What are we taking a look at? All right. So first of all, while I'm doing this, make sure that you like, subscribe, and share to the YouTube page as well, because there's more information that I put out there as well. And just let me know your thoughts if you think that things are going well. I mean, what do you think? Do you agree with me? Do you think that the home loan interest rates are going to be under 5% by July 1st, like I keep saying? So here we go. Right now we're at 6.125, which is up, right, from where we were Friday. And we have a tiny little bit of a credit here. But if we open this up to get back into the fives, we're only going to have to pay $76 to be at 5.99. We were at 5.875 pretty easily last week. So you see we've moved away from that, which makes sense and coincides with our being down 39 basis points on our mortgage-backed security. So if somebody wants to pay a point, they're at about 5.75 right now with just over a point on a 30-year fixed conventional home loan with these parameters. Take a screenshot for compliance purposes. All right. Now let's go ahead and take a quick look here at where we are on our FHA, VA, USDA, government products. Really, when I pull up the FHA here, the USDA and the VA are going to be very close. But what I am showing you is FHA. So you can figure that USDA and VA are going to be very close. So right now, a 30-year fixed FHA loan with 3.5% down, 5.625 with a little bit of a credit if you have good credit. A little bit of a credit if you have good credit, like good credit score. If you wanted to pay a little bit more, maybe a point, you're going to be looking at somewhere between 5.375 and 5.25. All right. So just to wrap it up here, you see that overall the interest rates are a little bit worse today, but we always want to get ready for a little bit of buffering or hedging ahead of such a big report like the personal consumption expenditures, as well as, remember, whenever you're having a long time away from the market being open. So again, this is a holiday weekend coming, which means we're going to close early on the bond market here on Friday. That allows a lot of time to pass where things can happen globally that would affect mortgage-backed securities in a time when people can't buy and sell mortgage-backed securities or bonds because the bond market is closed. Banks tend to hedge their bets a little bit, take a little bit higher interest rate position on the mortgage-backed security ahead of, just the fear of something happening when they're out of control and can't make an adjustment. So we're going to keep you posted through the rest of the week. We're going to prepare our game plan for the personal consumption expenditure, which is coming out on the 23rd later in the week. Let me know your thoughts. Have a good day, and I will talk to you again tomorrow.